Welcome all to the Node Show. I am Mike, aka Veteran Crypto, and with me here in a couple seconds will be David. He is always fashionably late. It's like a prom date. We had a great weekend. Jeff and David made it back home safe, so happy about that. And we're going to get into a little bit of a deep dive today. I'm going to go over some news, but Ondo is trending right now. So there's been a little bit of positive price action, and everybody's going nuts about it, as usual. It's anytime there's some good price movement, some good news, some speculative price pumps. Everybody goes nuts. Everybody starts posting about it. So we're going to give a little more even keeled outlook on both Ondo and Ton. And we are also, let's go ahead and get into the socials here while I'm waiting for David. So if you want to join the conversation with the rest of the crew inside of the chat, you can come on over to YouTube at the Node Network, all one word. We are also live on Facebook, Twitch, Kick, and X, as well as Arena. So feel free to join us on any of those platforms. But if you want to join the chat, you need to be on YouTube, Kick, or Twitch. For whatever reason, we can't chat with you on Facebook, but you're welcome to watch there. So we are truly a network. So we have this show Monday through Friday at 9 a.m., the Node Show. We have Crypto and Chill, which is tonight, Tuesday night, and Friday at 5 p.m., where me and Jeff go through just kind of what's happened in the past couple of days since the last show. The Blockchain Report on Monday, Wednesday, and Thursday. That is immediately after this show, where Jeff finds very early projects, often before the token generation event. So there's often opportunities to where you can farm airdrops and things like that. He's our subject matter expert on that. Sovereign Soil. That is my solo show where I talk about and sometimes have guests. I've had Drew on before. I've had one of our community members, Jay, who is with Ellie on the crypto and gaming show, on Wednesdays and Sundays. But this is where I share my decades of knowledge from the military, from emergency preparedness, from homesteading. And this episode here, I shared my experience with how I built my own cabin, and I don't mean I paid for it. I mean I built it with my own hands. So we talked about the selection of firearms. We've talked about what to do during an EMP event. We've talked about being the gray man and situational awareness. We like to touch on everything. So we like to touch on everything. And then market wrap. So David does a daily market wrap Monday through Friday at 1 p.m. Pacific, 4 p.m. Eastern when the markets close. And on Tuesdays and Thursdays, he does live coaching with Ellie. So on Tuesdays and Thursdays, he does that coaching I was talking about. But every day for about 15 to 20 minutes, he does live technical analysis on all your favorite projects. Crypto, DeFi, traditional finance, stocks, commodities, all of that. So if you want to take a look at your project or take a look at an investment that you're thinking about getting into and you're wanting to know if it's a good entry, go ahead and pop on over and take a look. We have Saturday Night Fever for those that are interested in that style of music. Jeff has been interviewing DJs around the San Francisco Bay Area and doing some really good interviews, and then also doing a bit of music at the end and often tutorials. So if you're interested in learning how to mix and how to do those sorts of things, great show to watch. Or if you just want some background music, while you're doing some work or something like that. The Red Pill on Thursday evenings. We talk about everything from ancient civilizations to the medicinal use of mushrooms and marijuana and all those things. The recent decriminalization or rescheduling of marijuana on the federal level. We talk about politics, religion, all the things you're not supposed to talk about. We usually just have drinks and debate different topics. And then Gaming and Chill on Wednesdays and Sundays at 6 p.m. And that's where Ellie and Jay jump on. And usually it's Arc Raiders, but they've been playing some other games as well. So go ahead and jump on and join them for that. It'd be interesting to continue that one, cover newer vehicles with that kill switch being at. That's true. That's true. The newer vehicles where they're trying to pass it to where basically they can remotely kill your vehicle if you get in and they feel that you're in duress or distress, which is, I think, a very bad idea. But that's actually not a bad idea, Ellie. I might have to take a look at that. Yeah, and getting parts for older vehicles is getting much more difficult. I've actually was just talking to David about that on our way back from town the other day about how a lot of the older vehicles, the aftermarket parts, a lot of the companies that make those are starting to go out of business. All right. And then next up, if you want to follow us on X, you can follow us at the node_network. And if you want to find everything that we offer, the node.pro. And this is truly the node of the node. So I'm gonna blaze through this real quick. But if you want to check it out, this is where you find all of our no-cost educational material and a bunch of other material, some of which is going to be paid. But you can find our schedule, our programming. If you want to know what shows are on what days and all of that I just rattled through, just come here. If you want to take the courses, again, no cost, no catches, no gimmicks. Just come here, click if you're a beginner, intermediate, or advanced, and it will take you to the proper place in the curriculum. And it has quizzes, it's structured, it has video, it has audio, it has all of it. I believe you can even download the audio so you can listen to it, just kind of while you're at work or while you're driving or whatever it is that you want to do. The community. If you want to join the DeFi University School community, if you want to join our no-cost Discord, if you want to join the premium channels, which is the school, YouTube, and we have a separate channel in the Discord. For $99 a month, you can join an advanced group of students and David on multiple weekly live calls, where they share what it is, education, lessons, but also the community of people in there. It's like I said, it's a live video call where it's an open forum. They all share what they're doing, opportunities that they found, and maybe even mistakes that they made. So it is a great place to find a mentor. It's a great place to take your investing to the next level. Coaching. This is what I talked about that he's showing with Ellie on Tuesdays and Thursdays. If you want to set up a no cost, no obligation consultation, this is where you do it. You can come in here, set up a time to speak with David, and he'll do a live call with you, and you guys can figure out together if you're ready, for this, intensive 8-week, deep dive into your portfolio and getting you up to speed and getting you to a point to where you're a successful investor. Or he might steer you towards our no-cost content to get you up, more up to speed, more knowledgeable before you spend your money in your 8 weeks on just learning the basics. So we want to make sure that you get the most for your money, the most bang for the buck. And this, we decided over this past weekend, is going to be one of our top priorities. Our number one priorities is to get this dialed in, perfect, ready to go, so that those of you out there that want to subscribe to this, the newsletter, can do that, because this is going to be massively valuable. The reason being is that it creates a custom newsletter for the assets that you are interested in, not the ones we select, not the ones that that we just randomly pick. You pick the assets, the stocks, the commodities, the crypto that you're interested in. Build your portfolio, and it will go out there. And in a matter of seconds, I mean, I'll click on it and see if it wants to cooperate this morning. You can see it's going through. It's finding multiple sources to verify the data. and it comes up with the Bitcoin and ETH ETFs inflows and outflows. It comes up with the prices and what the 24-hour change is. It comes up with the ranges. So if you're looking to get into liquidity pools, if you want to do trading, it will give you the levels you need to know for that. On-chain data, flows, derivatives, catalysts, what the big news stories are, and all of this has hyperlinks so that you can verify the data that the newsletter is giving you. So this is what used to take me about an hour to go through and manually do for a lot less value. I had to do it manually and go across the internet. Now, in a couple of clicks, you get a much better product, and you can go and you can dig deeper. If you just have a quick 5 or 10 minutes and you want to go through and just kind of keep your finger on the pulse of what's going on with your portfolio, you can. If you have 15, 20, 30 minutes and you want to go deeper, you can. It's up to you. So this is delivered to you to your email and on screen daily. So, David, saw that you got home okay. What's up?
I am research for Ondo and Ton. I also want to see if we can talk about the NEAR protocol. So Ondo, Ton, and NEAR is what I've got on the agenda for later on today during the second half of the call. And when I'm taking a look around at markets, yields, yields. That's the thing to watch. With the 10-year up at almost 4.7%, it broke out. It broke out to the upside, and it should continue to push higher as long as crude oil remains above $100. Same thing with the 30-year. The 30-year broke out above resistance and it's closing in on 5.2%. But it's not just U.S. yields that have broken out. Japanese yields have broken out too, with the Japanese 30 up at 4.15%. And then if we take a look at USD JPY, I know that there have been, and I know that I'm not sharing my screen here, but I know that there have been a handful of developments here with, the Bank of Japan intervening to support its currency. And, if we just take a look at this real quick, USD JPY, if this gets above 162, I think it sends up to 200. So we've got to watch this 162 level for USD JPY. And it's also important to watch the Japanese 30-year because at a certain point, if this continues pushing higher and suddenly yields in Japan on 30-year paper are higher than they are in the United States, you might see a rotation out of US risk-on assets. But, the thing for me, Mike, that's most important right now is what the 10-year and the 30-year in the United States are doing. So if we just take a look at the US 10-year, you see this level of resistance that I've got drawn in on this chart here. This is the yield itself. So this level of resistance broke to the upside. So we're getting a breakout in yields, and that corresponds to a breakdown in notes. So you can see notes here, notes breaking down below this level of support. Same thing with, I think probably the same thing with the 2-year. So here's the 2-year. It already did break down a couple of months ago, back in the beginning of March. And this is critically important for us to watch. All of the other stuff is great, right? Like, tech stocks, AI, crypto, whatever. But the US Treasury market is so much bigger than all the rest of them. And all the interest rate swaps built on top of it. Like, this is the market to watch. And when I see the 2-year breaking down like this, it tells me that the Fed is going to have to hike. Like, there's no more cutting. there will be no more cutting. We're going to be hiking. And so if we take a look over here at Fed Watch, 29 days until the next FOMC meeting, and we just take a look at the probability, like what people are expecting. Currently, it's 350 to 375. This is basis points. So the Fed funds rate is between 350 basis points and 375 basis points. So that's between 3.5% and 3.75%. Now, let's see if there is a possibility of a hike. It looks like there is not a hike is not being priced. There's only a 1% chance right now priced of a cut. But yeah, it looks to me like the Fed is going to have to start hiking rates if crude oil and yields don't pull back. So, we got that PPI print. If we just bring it back on over here to TradingView real quick, and we take a look at US PPI. This is the producer price index. And if we just take a look at this year on year, so we can see the change. PPI at 6% is like catastrophically bad, like really, really bad. So yeah, we've got all the earnings growth in the world from those big tech companies, but at the pump, consumers are getting squeezed, and we're about to see another
Dude,
round of inflation.
tell me about it, dude. I think I filled up like 3/4 of a tank in diesel, and it ended up being like 120 or $130. It's just fucking ridiculous.
Yeah, and it seems as though there's no end in sight for that. Just like you see, this is the 1970s double dip inflation,
Mhm.
and this is the 2020. So this is the COVID inflation, and
Yeah.
just so that we're clear, the COVID inflation was 100% a result of policy. It was the lockdowns, it was the money printing. It wasn't the flu, the disease itself. Like COVID was like a mild cold. So like it was the policies. It was locking everyone down, forcing everyone to stay home, by decree, and then printing $4 trillion like in a year and a half. That's what caused this. And so now we're getting this second, push to the upside, and I believe the Fed is still buying treasuries. So that's inflationary for the money supply. And the reason why the Fed is still buying treasuries is because there's no other marginal buyer. Like no one wants to buy US government debt. So the Fed is forced to monetize this ridiculous deficit spending. So we're going to continue to see, asset price inflation, and at the pump, gas prices are going to continue to remain elevated. They might even go up from here, and food is going to inflate again. So like this 6% on the U.S. PPI, this is the leading indicator for CPI. And so if we take a look at US CPI and we take a look at this on the year on year, so this is still hovering around like three. I think the last print was like 3.2, and this is a median. So this, what I'm showing here, I just want to go US CPI. I don't want the median. I want the year on year. So the absolute CPI, that's not what I'm looking for. I'm looking for, and honestly, like this number is complete bullshit anyway. Like the way that they've changed the calculations since the 1980s has made it such that this is basically useless now. So if we just take a look at like a trimmed mean year on year, I'm still not getting the right print. So the print for CPI was like 3.1 or 3.2 or 3.3, something like that. But the thing about CPI is that it is led by PPI. So the PPI is the producer price index. So if I'm a business and I make toilet paper or I make gasoline or I make, the thing that I sell is groceries, food, whatever it is, and I've got all these input costs, right? If my input costs go up, then my marginal cost to produce a good goes up. And so I have to, in order to stay in business, pass those costs along to the consumer, and that pushes up CPI. So at PPI up here at 6%, it's a leading indicator for the consumer price index. So we're
All right.
about, yeah.
Oh, let's we got about 40 minutes before the deep dives. I've got some news I'd love to dive into. Let's see what we got. We got TradFi and DeFi. The SEC is posed to unleash tokenized stocks. So this is kind of one of the reasons why me and David wanted to talk about Ondo today. It's been getting a lot of mind share, a lot of attention, because of its place in the tokenized RWAs. So Insiders report that the SEC could issue a conditional innovation exemption for tokenized securities as soon as this week, following its earlier approvals for NASDAQ and the New York Stock Exchange to build tokenized share trading platforms. This move would allow traditional institutions to pilot blockchain-based trading and instant settlement without full rigid registration. The infrastructure angle. Wall Street analysts are increasingly shifting how they value crypto firms, moving away from treating them as speculative brokers and toward valuing them as core AI, capital markets, and infrastructure platforms. So I've been seeing the reason I was talking to you about Ondo this morning, David, is all over X. As you all know, I get up at 5 in the morning and pour over social media and news to see what's going on, and just Ondo has been everywhere. And we're going to get into it here in a bit with the deep dives, but I need people to understand, and as long as you have this knowledge, if you want to invest in Ondo and other projects with similar tokenomics, that's fine. We're just here to educate. What you do is up to you. But it is important to understand Ondo is a governance token. It is not a utility token. You have to understand that there is a disconnect between the success of Ondo Finance and the token. But that being said, I mean, what is your thoughts on this news about the SEC poised to unleash the tokenized stocks? Because I know that that's something that you've actually started incorporating into a lot of your advanced strategies.
Yeah, Chair Paul Atkins, his Project Crypto initiative, and which is my understanding is that it's being championed by the commissioner, Hester Pierce. They've, what you were saying, Mike, this innovation exemption. So it looks like they're going to make this shift from these experimental sandboxes towards a live regulatory framework, which is basically aimed at migrating public equities onto blockchain rails. So this innovation exemption, it creates this specialized experimental pathway for crypto native platforms, think Hyperliquid, and decentralized protocols to offer tokenized versions of publicly traded stocks. So, traditionally, trading equity securities in the United States requires strict adherence to these regulation. It's called NMS. So, Regulation National Market System. So, Reg NMS, and operations through registered broker dealers and national exchanges like the NASDAQ or the NYSE. So the SEC's exemption, it's going to loosen these rigid structural rules temporarily to let blockchain platforms combine trading, clearing, and settlement into a single on-chain process. So, hey, that's great. It means, more efficiency. It means lower costs, or at least it should. You see, here's the thing. I don't trust anything that these institutions say or do. So, just the fact that it should be made more efficient, which means costs for consumers to buy and sell stocks should come down, it would not surprise me in the least if some bank somewhere decides that, hey, we can't lose our margins. So they're going to tell the SEC, like, hey, you know what? We're going to have to bake in, a little bit of a spread into that, tokenized equity offering. And that just makes it an inferior product compared to what you can get on chain. So, yeah, we'll see what happens with this, but I think that it's a big net positive to be able to trade stocks, from your DeFi wallet. The thing that I'm really looking forward to, though, Mike, is being able to trade options on these equities from my DeFi wallet. That's really what I want to be able to do, because there is not currently there is no decentralized options trading protocol that actually works. Like, Derive, I don't think Derive is real. I think that Derive.xyz, I think those markets are fake. And there aren't any others. So, I'm really, really looking forward to options on chain, liquid options on chain. Tokenized equities, that's great. But I'm always concerned about surveillance. So the thing that concerns me about the tokenized equities here, Mike, is that okay, great, we're going to get tokenized equities. We're going to be able to trade this stuff. But I think it's going to be highly regulated and surveilled. And for me, that's a no go. That's a non starter. So I'm really looking forward to it, though. I want to see what they end up cooking up.
No, absolutely, and it really, I mean, it's I know it's something that you've talked about before with the actual owning the actual stock, and then these tokenized versions being synthetic version. So there definitely needs to be part of the Clarity Act or some sort of legislation that owning these tokenized versions, we need to ensure that if we're investing in these, that we understand if and some may or may not be, but if that owning that gives you all the legal protections and all the legal rights that a actual stockholder would have, as far as voting and dividends and all those sorts of things, because there's some stocks that pay dividends. So if you're buying these tokenized versions, potentially the issuer of those tokenized versions, maybe because they if they're backing that with the actual stock, maybe they're the ones that are collecting the dividends. There's a lot that still needs to be kind of pulled back, and maybe that's something we need to do a deep dive on. Is
Yeah, yeah, 100%. Because they're not created equal right now. All
no.
of these tokenized equities that you can currently trade on chain. I know that there are some on Solana. There are a couple that trade on Hyperliquid.
Yep.
You can trade this stuff on a couple of other EVM chains, probably on Sui too. But my understanding is that those are like wrapped versions, and according to like the laws in like Switzerland or something. So yeah, it definitely seems as though there is a risk of market fragmentation,
Mhm.
because if third parties can tokenize any stock without the issuer's permission, you
Yeah.
could theoretically have dozens of these different wrappers of like Apple stock or Amazon stock, and they would
Yeah.
all be trading on different blockchains simultaneously. And so, yeah, that would probably not be a good thing. So,
No, and it's to kind of put it into perspective for people that are more crypto based, it's like the difference between native Bitcoin and a wrapped version of Bitcoin on Base or on Ethereum or some other chain. They are not the same. Native
right.
Bitcoin on Bitcoin mainnet is a much different asset than a wrapped version. And we've seen it time and time again, with a lot of these exploits and things like that, where a lot of these synthetic versions of these assets that we like are exploited, whereas Bitcoin itself has never had that issue. So
And so even it doesn't even require that it get exploited. So I had a client once who he engaged me to help him exit a position that he had on Phantom. So if you recall, there was a chain last cycle called Phantom. It like rebranded to Sonic. I think it was called Phantom. And Phantom ended up dying. And so there was very, very little liquidity left on the Phantom chain.
it, didn't Phantom like rebrand into something else?
Yeah, it became Sonic.
That's it. That's it.
Yeah, yeah. And so he had two BTC on Phantom. He had two
Oh,
WBTC,
no.
right? And so, like, here's the thing: if you've got, WBTC or some Bitcoin derivative on a chain other than the Bitcoin mainnet, right? You don't actually own spot Bitcoin. You've got some Fugazi token. And so he engaged me to help him exit his WBTC on Phantom. And that was back when Bitcoin was trading for like 90K. So he
Yeah.
had two of these Bitcoin, these tokenized versions of
90K.
Bitcoin. He had almost $200,000 in this fake Bitcoin, and this derivative of Bitcoin. And we were unable to find liquidity to exit for any more than like it was a 90% haircut.
Oh,
So yeah,
dude.
yeah. So like you got to be careful, because if
Yeah.
you own WBTC, let's say that you own WBTC on ETH mainnet, and then there's some problem with the custodian BitGo, and suddenly people don't trust BitGo. You think people are going to want your WBTC for stable coins? Hell no. And so if you've got WBTC and all of a sudden there's some issue, it might depeg, you know?
Well,
So you just got to
all
be
of,
conscious of that.
all of this is a testament to education, and why it's so important, and why we feel it's so important to offer the free educational tools that we do, and and why we do this show is it's important that we understand what assets we're investing in, and something as simple as deep liquidity, and why we avoid these smaller fly by night platforms that offer crazy APYs to provide liquidity. The reason is because they need liquidity. Without deep liquidity, it's the risk is exponential. So, that's why me personally, I stick to DeFi protocols with, really good risk management and very deep liquidity. I would rather make less yield and know that I'm in solid assets on a solid chain with deep liquidity, with good risk management. It's one of the reasons why I never put deposited liquidity on Aave. Is the APR, the APY wasn't that great there, and I didn't like how they pooled their liquidity. And we saw how that played out.
Yeah, when I was first learning to trade options from Tom Sosnoff and Tony Batista, from those two guys, one of their mantras was about liquidity. If the liquidity is not deep, you don't trade. So
Respect the liquidity.
you got to respect liquidity.
You got to respect the liquidity.
Yeah. You can't trade if there's no liquidity. You can't
No.
do it.
Well, and you get stuck with slippage. I mean, if it gets to a point to where the liquidity starts getting thin, then and you're trying to everybody's trying to yank their liquidity out, like the guy that you talked about. He ended up taking a 90% haircut and only got 10% of his liquidity out. I mean, he got some out, but the reason is slippage. He got dinged for 90% because the liquidity wasn't available. So, you need to understand these things, before you start depositing liquidity. Otherwise, you might be the one left holding the bag while everyone else, is, getting out with their money, or not exposing themselves to that kind of risk.
You don't want to
Oh,
be the exit liquidity.
no, you definitely do not. All right. DeFi deep dives and ecosystem trends. So, smart money liquidity, Wintermute drops Armitage. So, market making giant Wintermute has officially entered the yield and vault space with its new curator platform, Armitage. Armitage is specifically designed to support complex, exotic collateral types that traditional DeFi curators are too risk adverse to handle. Interesting. The context. This comes as institutional capital seeks safer yield vehicles. Galaxy Digital and SharpLink just launched a joint 125 million DeFi fund to inject dry powder into the sector, proving that smart money is looking past recent exploits to build next-gen liquidity structures. And the data shows this. Regardless of prices dipping, regardless of these exploits, the liquidity is not leaving the ecosystem. It is leaving specific protocols and specific chains. They this Kelp DAO and the RSETH exploit, and just all of these different things. I mean, all it's doing is educating them on what to avoid. And we've all done it. We all have that price of education. Again, it's why we offer all our Discord and this channel, and the DeFi University at no cost, because we genuinely just want you all to be educated and successful. But it's on you if you take advantage of these things. So
It's called market tuition. You want to
yep.
avoid paying market tuition as much as possible.
And I know people that have paid hundreds of thousands of dollars, in market, tuition, because they jumped before they didn't, do their research before they jumped in.
Yeah. Yeah, and there are a lot of beginner mistakes that you can avoid making if only you have someone who has already made those mistakes that can show you what to not do. Much of what I do in the coaching program is just showing people obviously what to do, but showing them what to avoid. You've got to know what to avoid. That's extremely important. So if we're taking a look at this, Wintermute and Armitage. So let's see here. What types of exotic collateral are they going to start using here? It looks like maybe some LSTs like Lido's Staked ETH and Rocket Pool's RETH. It looks like maybe some RWAs like US Treasuries and maybe some private credit stuff. Definitely stablecoins, USDC Select, they're calling it, USDC Prime and USDC Select. And check this out, Mike. They're deploying their first two vaults on Morpho. On Morpho. So
We've been screaming from rooftops for a while, that base network just seems like it just keeps on making strides to be where institutions are moving their liquidity, and Morpho and Arrow, being, the major platforms on that chain. Arrow is, last I looked, like 60% of the volume on the base network. It's going multi-chain. That's just on base. They're going multi-chain. They're going on ETH mainnet and like 10 other chains, OP mainnet and a bunch of others. So, I mean, those protocols are already giving, Aave and, Uniswap and, the OGs a run for their money. And, again, Aerodrome is only on the base network. So, I can't stress it enough that, staying up to speed with how this ecosystem evolves, and it can go the other way too. I mean, not to say that, it's a guarantee that, Aerodrome, Morpho, or, base network is the future of finance. Something else can come along. I mean, hell, Canton came out of nowhere. Me and David were talking about this weekend. They were building for 10 years. I never heard anybody mention Canton. And then until it popped up on RWA.xyz, and me and a couple of people started talking about it. And, all of a sudden it, has $400 billion of TVL, and, all these, major, the New York Stock Exchange and JP Morgan Chase and all these major institutions are, launching on it, and, not talking about it. They are actually launching on it, and it's just going crazy. So, I mean, it's not to say that something, better can't come along, but, as of right now, I mean, that's where my sights are set. Is, I mean, I just see Base Network doing all the right things.
yeah, and you talk about liquidity. Liquidity is super important, and because Base is basically backed by Coinbase, you talk about deep pools of liquidity. Think Coinbase.
Yeah.
They are the custodian for, I think, all of the Bitcoin being held by those spot ETFs. Maybe not like 100% of it, but I think it's like
Well,
98%.
institutions, yeah, they're
Yeah,
the institutional custodian of
right.
all that, and, a lot of their offerings on their platform, like the lending and stuff like that for Bitcoin, and, all those sorts of things. For down payments on mortgages, and if you just want to take out a loan on your Bitcoin, that's done through Morpho. All of, the interface, the UI, is on Coinbase, but that's facilitated through Morpho in the backend. And Aerodrome, the new Aerodrome platform, is being built out to be the liquidity hub for Coinbase and all of that, and to include institutions. They're adding institutional, pools and things like that. So it's going to be really interesting to see how this plays out, because, and another big thing is, of course, Coinbase, because, we all know, because of the Clarity Act, they're deep in Washington. They know what's going on with regulation, and they are making the moves to ensure that they are compliant. And that is where institutional money is going to go, is whatever is compliant and that can be upgraded to stay compliant as that, environment, evolves, as new legislation moves forward. So they're building out all of this stuff. The new Aerodrome platform, Morpho, Coinbase, the base network, to where it's going to align with attracting that deep liquidity that we were talking about from institutions. And if you, as a retail investor, yes, it's going to be very centralized. If you want to be decentralized, you're going to have to go to other places. There's going to be KYC and AML and all that stuff on these platforms. But if you want that safety net of that deep liquidity, that we were talking about the pitfalls of not having that deep liquidity, these are going to be the places that you're going to want to operate.
Yeah, and the Morpho token itself. I was just taking a look at that, but it's there are a handful of tokens today that are getting a little bit of a bounce as
Mm-hmm.
we're really not seeing Bitcoin continue its slide to the downside, not in earnest today anyway. It seems as though the S&P and the Nasdaq are, even though they were off a little bit more earlier this morning, they've been bid the last couple of hours, and Morpho is holding above its 200-day moving average. So that's definitely a big positive for the Morpho token. That protocol, I quite like Morpho, but
Mm-hmm.
I got to say though, I prefer Euler to Morpho simply because Euler is permissionless. I believe that Morpho is permissionless too, but it's easier to launch stuff. If you want to build something new, maybe
Mm-hmm.
for yourself or for a family office or whatever you want to build, Euler is the place to do it, I think. On Morpho, I think you need, like, maybe not permission. I've just never built on Morpho. So maybe I should try. Maybe I should try launching a vault on Morpho. That would be interesting.
Yeah.
Yeah.
No, and I know that a lot of institutions have, like Steakhouse Finance, and a lot of those, they're the curators of a lot of those vaults. And we've talked about the architecture of Morpho being superior to things like Aave, because of the fragmented liquidity, to where it's not all co-located. It's each vault curates the liquidity and the assets that consist of that, that the vault consists of. So yeah, no, it's been very interesting, to watch. And I've kind of felt like that this was what was going to happen, as the institutional adoption moved forward, and as this ecosystem matured. Um, just because before, I mean, it was the Wild West. It was pretty much all retail. It was driven by emotion. It was driven by retail. That's where we saw all the volatility. Whenever you saw something hyped on social media, things would pump, 50, 60%, things like that. And we're just not seeing those kind of moves anymore. We're not seeing those massive moves on, speculative news. I mean, shit, you used to, see where, XRP or Ripple was, in talks, or, that they sat on a stage, with JP Morgan Chase, and you'd see it pump, 20, 30%. Now you get solid news. I mean, like good, solid news, on a project where it's getting massive adoption, and an influx of actual liquidity, and it might move like 5 or 10%.
Yeah, also, I just take into consideration the fact that it's still a Bitcoin bear market. So we don't really have the same type of, interest in crypto right now.
Well, even
That
during the bull market, that we that we just
I
went,
know, I
you
know.
know,
I certainly do hope that this next bull is characterized by more retail adoption of digital assets, rather than what we saw last bull market, where it was kind of lukewarm,
it was a
like
cash-rich,
mediocre.
it was a
It was
cash-rich
like it
market.
was like
Like,
ugh,
that was the
it was just
shittiest bull market. I waited like 4 or 5 years for that shit, and it was like, it was like going to the strip club, and you like discover that it's a tranny strip club.
they all have Down syndrome or something.
Oh, dude, it was like the B lineup. It wasn't the A lineup. It was the B lineup.
Yeah, you got a bunch of fat retards with Down syndrome coming out and shit. But like, here's the thing, man. Like, if you held Bitcoin, did pretty good. You know, you didn't have to do shit. Just buy Bitcoin and that's it.
Yeah.
You bought Bitcoin at 16K and held to 126. You're happy, you know. But if you buy, a dog shit coin, then probably not too happy, right? So buying alts is very, very difficult. And so
Yeah.
that's why we spend so much time doing these deep dives because you have to be able to discern for yourself. Number one, does the protocol make money? And number two, does it return those revenues to token holders?
And
And
we're going to
yeah,
keep screaming this from the rooftops. And sorry, but not sorry. I mean, we speak the truth here, and I mean, we do it on projects that we're bullish on as well. We're going to give you the good and the bad about the project. If that's it's it's tokenomics, it's fundamentals, whatever it is, we're just going to give you the full picture. We're not incentivized, and it's why we're so big on this. We're not incentivized to talk about any of these projects, good or bad. But you need to understand, how all of this plays into price go up or price go down. And projects that where the tokenomics are such, what David was just talking about, is it doesn't matter if the company that launched the token, it doesn't matter if they are the only crypto project on the planet and they're handling hundreds of trillions of dollars in liquidity. If the token does not have a direct correlation or connection to the profitability of the company, because if there isn't a way for that value to be shared with token holders, the price is pure speculation, up or down. It's basically good news. A couple of market makers throw some money in, make price start to go up. Everybody FOMOs in, and then those market makers that started the pump because they got in at the bottom, basically, they start peeling off their profits and using you as exit liquidity. That is what goes on social media, like Ondo right now. That's what's going on. Is they put a bunch of money in for all this good news that was coming out about Ondo retail, and all these little hype monsters come out and start hyping it up to get more and more people to buy in. And all the while, during that pump, you can see it in the charts. I'm sure David will go over it, and you can see it in the charts. It pumps, and then it starts to pull back, and that's all those people, those market makers and the smart money pulling their profits out, which is your money. You're their exit liquidity. And then they rinse and repeat as many times as they can, just like on the heat map. When you see them, pumping it to liquidate the shorts and dumping it to liquidate the longs. It's a game for them, and they are masters at it. And you need to understand how they do it so you can avoid being exit liquidity.
so Mike, something that has come up on my feed on X. Look, I live, sleep, eat, and breathe this stuff, and AI too. And what's come up on my feed on X is a couple of posts about protocols that actually make money. Okay, how many protocols, Mike? Can you guess how many protocol? I'll give you a hint. It's fewer than 20. How many protocols over the last 30 days generated greater than $5 million in revenue? How many would you say? It's fewer than 20.
I would say it's probably fewer than 10.
16.
Okay.
16. So just think about that for a second. Only 16 protocols of the nearly 1,000 protocols that are on DeFi Llama, only 16 of them are actually successful.
Well,
Like,
and out of those 16, what is their profit relative to their market cap, and what is the tokenomics of those projects, to where do the token holders, benefit from that profitability at all? So I'll bet you that would take us under 10.
so check this out. I've got the list right here. It's, number one and two, Tether and Circle, because
Oh, yeah.
their business model is like, their business model is so good for them and yet also so horrible for consumers who hold Circle and Tether tokens. Like if you hold USDC and USDT, like you should be earning US Treasury yield on that. But that was made illegal by the Genius Act.
Yep.
So, like, what the fuck? You
Yep.
know? So, number one and number two, Tether and Circle. Number three, can you guess what it is, Mike? It's your favorite. It's my favorite too.
Arrow.
Canton. No, man. Canton. Yeah. So number one and two, Tether, Circle, Canton. Of course, Hyperliquid's number four. And then you got the Solana Casino.
Making like a couple $1 million a day.
Right. And then you've got that Solana. Yeah, I know. You got that pump fund, Solana Casino. And then you've got Tron, the Tron DAO, and then Polymarket. And then we've got some institutional stuff, Grayscale, Sky, the Sky ecosystem that used to be MakerDAO. They rebranded to Sky.
Oh, okay.
And then you've got Ethereum. And then I'm not familiar with this one, Axiom Exchange.
I've heard of it. I don't know anything about it, but I've heard of it.
And then you got Paxos. They tokenize all sorts of stuff. Aave, Phantom, the wallet. And then here's another wallet exchange, EdgeX. And then the last two, I don't know anything about, Titan Builder, XYZ, and Courtyard IO. Yeah, so those last two, Titan Builder and Courtyard IO. But like, just think about this for a second. We're talking about only 16 protocols in crypto and DeFi that make more than $5 million a month. Like, there's only 16 that are actually like highly successful.
Well, and then you go to freaking, you go to CoinMarketCap, and you look at, out of all those that you mentioned, Tron, Hyperliquid, and Canton are like the only ones that are really, like in the top, even the top 20 or top 50. And you got stuff like, Shiba Inu and, Dogecoin, which are both meme coins that have $33 billion of market cap. And, BNB with, 86 billion, XRP with 84 billion. It's like there's, it shows you that the valuations, because that's what the market cap basically is it's what people are saying that this company is worth, and it's nowhere near what it's actually worth. And as soon as people wake up and realize that these projects are severely overvalued, but as far as market cap, it is going to be ugly. It is why it is so important that when we get into these deep dives, that you understand this fundamental principle of how these businesses, and the services they offer, and the products that they offer, that we start treating these as traditional valuations. That we start looking for projects where the market cap is at least somewhere in the ballpark of the revenues that they generate. Like Canton. Canton is number 17. It currently has a valuation of $5 billion. If it's making $2 to $3 million a day, do the math. That is a somewhat accurate valuation. Whereas you got something like Dogecoin that's $16 billion. What it doesn't generate any revenue at all. So
it doesn't do anything.
It doesn't do anything.
It does nothing at all. And same thing with Shiba Inu. Like, those meme coins do nothing. Same thing with XRP. It does nothing. So, yeah, I think that there's quite a few of these crypto and DeFi protocols projects that are massively overvalued. Massively overvalued. So
really, really quick, we got 5 minutes, and then we're going to get into the deep dives. But this is that TitanBuilder.xyz that you were talking about, David. So it says, "Hello, searchers. We are a neutral block builder on Ethereum. We support the standard endpoints and ETH send bundle with replacements and cancellations, as well as refund percent. We have several exciting new products in the pipeline." So what is this? "We run multiple bundle merging algorithms in parallel through our proprietary high-performance infrastructure. We do not use bundles for anything other than building competitive blocks. to avoid any conflict of interest. We don't do any searching on Ethereum. Relays. Do you know what this is? This makes no sense to me.
They sound like a validator or a block builder. So if you're, a validator and you build blocks, you can structure how transactions get into the block, and they could also front run and back run. I'm pretty sure that I saw them running an MEV bot at one point, or maybe it was just an MEV bot with the name Titan. Um, it basically just front runs and back runs transactions to create a sandwich, which gives the trader artificial slippage, and they extract that. It's maximal extractable value. But I think this could just be a block builder.
That's what it looks like, because it says here, block building algorithm. Our builder runs multiple sorting algorithms concurrently that compete against each other to produce the most valuable block possible. Sorting of bundles and transactions is not necessarily ranked by effective gas price, and as such, top of block execution is not guaranteed. Based on how transactions interact with each other and the current state, including transactions with lower effective gas prices before higher paying ones, may yield more valuable blocks, which is what our algorithms optimize for. We will never unbundle a bundle and will never broadcast any bundles or private transactions to the public mempool.
Hmm.
Huh.
Got it. So yeah, I wonder. We should definitely do a deep dive on those guys. I wonder how trustworthy
Absolutely.
they are, because I had read at one point that there was like a Titan MEV bot, but I don't know if that was actually from those guys or if it was just an MEV bot named Titan. Not quite sure. So let's see here, Mike. We've got, let's see if maybe, because I'm still waiting for that video content on the Ondo, Ton, and I also produced some content here today for Near Protocol. That's another one of these layer one chains. But taking a look here at Ondo, why don't we see if maybe we can run through a couple of charts before we hop into this content on Ondo?
I'd be
I
very I'd be very interested for you to take a look at the charts, because a lot of the posts that I've been seeing on Ondo on social media is people trying to make it look like it's about to go to the moon, of course. And so I'd be very interested for an unbiased take, because I know that you're not invested in Ondo, or I don't think you are.
Nope.
Yeah. So I mean, this is 100% unbiased take. Like, what are you seeing on the charts?
Yeah, I'm seeing the same type of dead cat bounce that we've seen over the last couple of days, couple of weeks in most altcoins. So, as Bitcoin rallied off of its lows at the end of March, and held on to its gains until just the last couple of days here, as Bitcoin rallied, many alts rallied too. And if we take a look at Ondo was one of them that got a really really nice move, a nice pump here. So if we just measure this, that was an 85% pump over the course of like a week and a half. So people started getting Ondo was the buzz, right? Like people were talking about Ondo this, Ondo that, Ondo to the moon. I think Ondo moves back down to 20 cents or lower. Here's that 200-day moving average. Let me go ahead and grab this arrow. So here's that 200-day moving average. Ondo broke out above the 200-day moving average, just like a handful of other altcoins did, like Ton. Ton is another one that broke out above its 200-day moving average. But notice where it's trading now, right at the 200-day moving average after it broke down below it briefly over the last maybe 72 hours or so. So, for me, Mike, when I'm looking at Ondo, there's a couple of levels that we need to draw in now as resistance and support. So we can just throw down a horizontal here, 20 cents. That's some support. And then resistance on the upside, if the rally continues, is like right here, 62 cents. And so if this moving average fails, Ondo moves back to 20 cents. And I just don't see how it's possible for this thing to rally up to 62 cents if Bitcoin rolls over. So Bitcoin, put in this very bearish pattern. This ascending wedge rejection at the 200-day moving average, falling out of the wedge to the downside. This is super bearish. And it could just be a matter of waiting for the S&P to actually, push a couple of percentage points lower for us to see Bitcoin, start to really push lower back down towards 60,000 on BTC. So if Bitcoin, it's still a Bitcoin bear market, and the bear market doesn't end until October. So, at least that's what the cycle says. The cycle, Mike, is almost like a prophecy now. It's like it has been prophesized.
So let it be written, so let it be done.
Like the Bitcoin prophecy says that by October 5th, we'll have put in a low. It's not October 5th. So we're still in a Bitcoin bear. And this rally out of Ondo, this is a rally that you want to sell. Okay. So yeah, there's no way I wouldn't buy Ondo here with anyone's money. It just doesn't make any sense to buy this thing here. And we're going to learn more about this when we hop into the deep dive and the video content. But for right now, you've got resistance. Let's just call it at 60 cents. Resistance at 60, 61 cents right there, and support at 20 cents, trading at the 200-day moving average. I mean, this thing looks to me like it moves back down to 20 cents. If we zoom out on this from a daily to maybe a weekly here, and this is Binance data. If we just take a look at this on the weekly, this is a dead cat bounce. That's what this is, dead cat bounce. So yeah, if Bitcoin rolls over, then this one moves sharply lower. Now, what if, because I don't have a crystal ball. So what if Bitcoin rallies back up to 82K? I think that would be very unlikely given Bitcoin's, previous history during bear markets. When it gets up to its 200-day moving averages during a Bitcoin bear, it tends to get rejected at them or maybe just go a little bit above them. But if Bitcoin rallies back up to 82K, then yeah, maybe Ondo is able to rally up to 60 cents for sure. It's just, I don't think that Bitcoin rallying to 82K is likely. And part of the reason why I don't think it's likely is what's going on with yields. So this is like the canary in the coal mine for me. This is telling me like, hey, caution, like real caution, because it's so easy to get wrapped up looking at the NASDAQ, going from 23,000 to nearly 30,000, just missed 30,000 on the futures. It's really easy to look at this straight up and then to take a look at, the big tech stocks and the semiconductors and to say, hey, number go up, bear market in crypto is canceled or shortened, and let's just buy all the things. But I don't think that that's really what you want to be watching. You don't want to be watching tech stocks. You want to be watching interest rates, because this is what could blow everything up. If interest rates keep pushing higher and suddenly you see rates above 4.815% on the 10-year, then yeah, stocks are going to care about that. And so will Bitcoin. So will digital assets, because they're interest rate sensitive. So when I want to track the stuff that's more interest rate sensitive, I'll track the Russell. So here's the Russell 2000, and here's that 200-week moving average. I've got it highlighted with that arrow there. If I grab a trend line tool and just throw this down, something like that, well, we've got support for the Russell, quite a ways below, and we've got that 200-week moving average way down here. So, my understanding is that these interest rate sensitive stocks have rallied on the back of ISM, picking back up above 50. So that's a measure of manufacturing. So if manufacturing is picking up, it looks like, jobs are actually doing okay. Last month's job report wasn't all that bad. So it looks like growth is there, but inflation is also there. And, inflation means that the Fed is going to have no choice but to hike rates, not cut rates. And so since these Russell items are interest rate sensitive, if rates are going up, then this rally should start to peter out, and it has. And that should also mean that higher risk, higher beta assets like Bitcoin, Ethereum, Solana, etc., all the digital stuff, that this should pull back too. So it's been great to see this rally out of the NASDAQ, but as long as the US 30-year and 10-year and 2-year are breaking out, and the the curve is pushing higher. The curve is, it doesn't look like it's steepening, it looks like it's flattening and pushing higher. I think they call that a bull flattening. But yeah, this to me is the thing to watch. Not stocks, not cryptos, not commodities, but rates, because this can blow everything up. And that move index, this is the measure of bond market volatility. So I'm going to continue to watch this, because if we get another couple of weeks on the upside out of bond market vol, and it gets back up above that 200-week moving average and above like 115, that would likely mean that equities have rolled over, or are just about to roll over, which would also likely mean that Bitcoin, Ethereum, and Solana are likely pushing back down towards their, for Bitcoin, it's long-term, moving average here, the 200-week moving average, which comes in right now, all the way at 61 and a half, $61,500. So for me, this is the level to watch for digital assets. And so I view everything through the lens of Bitcoin. So if I'm looking at Ondo, I'm not really looking at Ondo. Like if I'm looking at Ondo, I'm really just thinking, okay, what happens to Ondo if Bitcoin moves to 61K? What happens to Ondo if Bitcoin moves back above 82K? I'm just thinking about this alt in Bitcoin terms. And so that's what we should probably do here, is price this in Bitcoin terms. So if we go Ondo BTC, and then maybe just grab like a trend line like this, maybe I can just cut off that wick right there. Hey, it got up to resistance and got rejected at resistance. So this is what underperformance looks like. Now, if Ondo were to break out, above this level of resistance in Bitcoin terms, that would be very bullish. That would be very bullish for Ondo. So it would really need to. So this, over the last couple of weeks, this is Ondo outperforming Bitcoin. So when you see this moving to the upside like this, this is an alt outperforming Bitcoin. But over the longer term, it has done nothing but underperform Bitcoin. So yeah, my thought process here is, what is Bitcoin doing? And what is that likely to do to Ondo? Okay, so I've got a piece of video content ready here, Mike, but it's for Near Protocol, not for Ton or Ondo, not
See,
yet anyway.
yeah, see, I want to make sure we get to the Ondo one, because I really think it's going to be doing a great service to the community, being able to get a deep dive into what I try to express on social media.
Okay, so let's do this. Let's take a look here and let's run through this slide deck on Ondo. So, Mike, my understanding of Ondo is that it's basically like a tokenization platform for toxic sludge, right? The return-free risk. I'm talking about US Treasuries. So isn't that what Ondo basically does? That it just tokenizes
Yeah,
treasuries?
it's
I
just
think
it's
so.
just a tokenization platform. It's basically, that's what they're all about, is tokenizing real world assets.
Yeah. Okay, so you've got this, permission legacy markets. So if we're talking about U.S. Treasuries, then yeah, those permissioned legacy markets, high yield. I mean, I guess I don't know that I would necessarily describe, U.S. Treasuries as high yield instruments. And then the settlement is very, very slow, intentionally so that they can, basically steal through the float. And then offline legal enforcement, right? Of course, and isolated pools of liquidity. Okay, and then you got Ondo bridging the gap, right? And this is what they do. It's a cryptographic and legal transformer converting sovereign debt into yield bearing on chain cash equivalents. So you've got these permissionless blockchain rails, right? Um, Zero yield stablecoins. So this is horrible. The only reason why those stablecoins are zero yield is because, well, number one, that was the business model of Tether and Circle, and number two, they were legislated to be zero yield. So if you're holding Circle and Tether, the company that minted those stables, they are holding yield bearing assets in those US treasuries, and they are not passing on that yield to you, the holder of the stablecoin, when they should. Imagine if there was an issuer of stablecoins that were pegged to the dollar, where that treasury yield, the majority of it, flowed to token holders. You know what that would do, Mike? It would kill Tether and Circle like overnight. Now that is illegal. So they they made it illegal for consumers to have a yield bearing stablecoin, which is like what? you know, we obviously don't have Congress people that work for us. They work for banks.
Oh, I think anybody that pays any kind of attention understands that.
And then, so on chain, you've got atomic 24/7 settlement, which is awesome. And of course, smart contract execution, and your liquidity is composable, which is great. Okay, so let's check this out. Split brain corporate architecture. So you've got Ondo Finance Inc. out of Delaware. And, a lot of companies have been exiting Delaware because they went woke. So, like, go woke, get broke. And companies are exiting Delaware for that fact. Software and protocol development, SEC registered investment advisor. Okay, so this is one part of their business, the tech and advisory part. And then it says here that the split brain creates bankruptcy remoteness. So that ensures that if the tech entity faces corporate insolvency or civil litigation, then underlying sovereign assets held by the special purpose vehicles remain entirely shielded, protecting end user capital.
That's something I didn't think about. So that's awesome. Like, and let me somewhat preface what we're talking about with Ondo here. Ondo has a great service and a great product. Ondo Finance, I love it, but it's the tokenomics that concern me. But go ahead, keep going.
Yep. The tokenomics concern me too. I want to get into that. So,
Oh, no. Yeah, don't skip ahead. I just want people to understand that just because I'm not bullish on the Ondo token doesn't mean I'm not bullish on on Ondo the company. And if they do the vote, that there's these rumors that supposedly later this year that they're going to vote and make Ondo a utility token as opposed to just a governance token, then I'll change. I'll change how I feel about Ondo if something like that happened. But go ahead.
Yeah. So here we go. We've got these different products that Ondo has launched. You've got USDY, OUSG, and OMMF. So USDY is that US dollar yield token. Okay, got it. So this is a tokenized bearer note, senior secured debt. That's
And
the legal.
there's actually a huge influx of liquidity for that USDY on RWA.xyz.
Yeah. And it says here that the yield mechanism is accumulating. So it's paying a 5% APY, which makes sense because 30-year treasuries are paying a little bit more than that. So 5% APY makes a lot of sense. It's, the regulatory exemption is the SEC Regulation S. Asset backing, so USDY is backed by short-term US treasuries and bank deposits. Okay, wow, great. And check out the target demographic. What type of bullshit is this? Global non-US? The reason why they say non-US is because US citizens aren't even allowed to hold this thing. Like, the fuck is that?
Do you know what where the top the top five? Do you know where the top five chains for liquidity for USDY? Can you guess?
I would think it's got to be mainnet and maybe Solana,
Solana's number 4, Ethereum's number 1.
and then Canton, maybe? Is it
Nope.
on Canton? Nope. Okay. Then
You're gonna be shocked by number 2.
Sui or
No,
Tron?
nope.
Tron? What is it?
So Ethereum's number 1. Plume is number 2.
Plume. Huh.
Plume is number 2 with like half $1 billion.
Wow.
Say is number 3. Solana's number 4, and Stellar XLM is number 5.
So what type of dollar amounts are we talking about here?
Ethereum is 876 billion, or million.
Million.
Sorry, 876 million. Plume is 445 million. Say is 225 million. Solana is 160 million, and Stellar is 110 million.
Huh. Okay. Great. Well, maybe we should do a little bit of a deep dive on Plume at some point. And then you got
I'm
this.
still holding my bag. It's it's a long shot, but I'm definitely holding out on Plume.
Yeah, so I haven't looked at that one in a while, but here's Plume on a weekly. Here's the
Oh
weekly
yeah,
chart.
price is shit. Price is shit.
Well, I mean, it had a pretty crazy pump just recently.
It just gave it back though.
It was all the way up at 2.2 cents for a short period of time. Yeah, a lot of volatility there. So let's see here. Let's bring it on
Back to
back.
Ondo. Sorry, didn't mean to get you off track. I just wanted
Yeah,
to look up
no.
USDY because I knew that there'd been a big inflow of of liquidity, from USDY.
Okay, and then we got the next one is OUSG. So this one is a tokenized LP fund, and this is for accredited and qualified US and global investors.
It's an Ondo short-term U.S. government bond fund.
So just think about how bullshit this is. Like if you're a retail investor and you want to earn, 5%, 4.5, 5% APY,
Yeah, you got to
and
be rich. You got to be rich already.
like what the fuck, man? Like you can't even hold this stuff. Like you're not legally allowed to own USDY.
It's bullshit.
And then OUSG, like you can only get, like I'm pretty sure the smallest tranche that they will allow you to buy is like $100,000. It might even be higher than that, but I'm pretty sure it's 100K. So like, dude, this is like not democratization of this type of US Treasury yield. This is gating of that yield. And so you've got, and then the last one is OMMF, Ondo Money Market Funds. And again, institutional and qualified investors only. So like, that's not cool. Like, why are people so bullish on Ondo if you can't even hold it unless you're already a millionaire? Like, it just doesn't. I mean,
well, you can hold Ondo, but you can't hold OUSG. So yeah.
right. Well, I mean, isn't Ondo just like a crappy governance token though? Like,
That's my understanding. I mean, I held Ondo for a while, until I started, focusing on the aspect of of the tokenomics, and understanding the fact that it's, for all intents and purposes, as it sits right now, it's nothing but a governance token. So it's like XRP, or XRP is just a really cheap gas token. It's not even a governance token, and there's no connection between XRP and Ripple, and the profitability. It's basically giving Ripple liquidity so they can grow their company. It's kind of what I see Ondo being. The token
yeah,
as it sits right now is you're helping them grow a highly profitable business, and they owe you nothing because these aren't stocks. There is no legal contract between you and Ondo Finance for buying this token, unless this presentation says otherwise. I mean, that's where all my research has taken me.
so check this out, Mike. Everything to do with Ondo is highly KYC. So that's another thing to just keep in mind here is if you are wealthy enough to be able to, swap in to any of these tokens here, OUSG, OMMF, or if you're not a US citizen, USDY. If you're able to do that, well, you're also going to be surveilled heavily. It's KYC AML up the ass. So yeah, just keep that in mind here. But this is kind of cool though, because if we go back to the OUSG, this one, if you're earning, let's just call it 5%, that's the accumulating and rebasing yield. You can take that OUSG and use it as collateral to borrow USDC or USDT. So that is, the OUSG, that token, the fact that it's composable makes it extremely useful. Because if you're earning 5% on your collateral and you can borrow USDC or USDT for, let's say, 3%, you got a 2% spread. You can apply some leverage to that. And all of a sudden on treasuries, you could be doing like 15%.
Yeah,
So
the problem is freaking, the government decides that, you're not rich enough, to do, to basically to make money.
or even worse, under a Democrat president, heaven forbid if that ever happens again, they would just say, hey, we don't like your speech. We
Yeah,
don't like what you're saying. And so we're going to blacklist you.
yeah.
It's like, great. So here we go. Omni-chain liquidity, the burn and mint imperative. Okay, so lock and mint. How do you what is this? Sits out on a smart contract. And this is the solutions. Are they still using layer zero?
I think so. Let me check and see if they're doing what a lot of other people are doing and moving over to Chainlink. I think I saw something where Ondo is moving to Chainlink.
Right. Yeah, I think everyone is moving to CCIP because
Yeah.
after layer zero got, effectively exposed with its pants down and, $300 million was stolen by North Koreans, then yeah, no one's going to use layer zero anymore. Okay, the future architecture, Ondo chain, layer one app chain. Right. So I remember reading that Ondo was actually a chain and that they were, going to allow people or institutions to build on it. So it says here permissioned validators. So for me, I am, look, it's great to know about these permissioned chains like Canton, for example, and Ondo is another one. But I will never use this stuff because this is just not what I'm about. I'm about permissionless building. So it says here permissioned validators, only regulated TradFi entities, so think broker dealers or banks, are allowed to run nodes. And they say that that mitigates MEV. If there's no way, like, if a bank or an institution wanted to extract value from its competitors also running nodes, they would totally do that. As long as it's legal or gray area, they would totally do that. And so it says while the chain remains open for public access, but public access only if you are whitelisted in the first place. So permission, this is a walled garden. They call them walled gardens. Okay,
So, so real quick, David, it looks like it's using both Ondo and Layer Zero for its cross-chain movement while heavily integrating Chainlink for asset valuation and data delivery.
got it. So it looks like it must be using Chainlink and Layer Zero at the same time.
That's what it looks like.
Got it.
It
Okay.
says Ondo is staying on Layer Zero for its cross-chain tokenized securities plumbing, and Ondo relies heavily on Chainlink as its official primary data oracle backbone.
Got it. Okay. Well, I certainly hope that Layer Zero, upgraded the number of signers required from, you know.
Yeah.
So yeah. Number three here, you've got enshrined oracles. So what does that mean? It says price feeds and proof of reserves are natively integrated into the base layer state machine, removing third-party smart contract reliance. Huh. Base layer state machine. So the oracles are just baked right in. I kind of like that, especially on like some type of a permissioned walled garden. I like that. That's a good thing. And then you've got native compliance, right? So KYC AML logic embedded at the module layer for automated compliant corporate actions. Right. So this is the important stuff for corporate and state actors. Okay, so let's check this out. Tokenomics, here we go. This is what we wanted to get into, the tokenomics for this Ondo coin. Supply, allocation, and structural dilution. Okay, so it says heavy centralization, 46% allocation between private and team subjects. Private and team subjects the market to daily block by block inflation. Okay, well, that's not good. And we need to know this, right? It says it's got a fixed supply of 10 billion tokens. And it looks like the top 10 addresses command 65% of the circulating supply as of right now today.
Ugh.
So, yeah, is right. It looks like a linear vest to early 2027 and then a linear vest to January 2029. So this thing is going to continue to inflate for the next several years. Okay, that's pretty crappy. All right, tokenomics 2, the utility disconnect. Okay, so you got funnel 1 and funnel 2. And it looks like funnel 2, that's the token utility for the Ondo token itself, where you've got DAO voting rights for Flux finance parameters only.
I
And
don't
that
think I'd call that utility. I think that would be more governance.
And so here's the Flux Finance. This is that lending engine where
Hmm.
you can supply, that OUSG token and borrow stables against it, only if you're whitelisted. So it's a walled garden. And then if we go back on over here, the actual token utility itself. So Ondo, the Ondo token, has voting rights, but only for that lending market, for those lending market parameters, Flux
Oh,
Finance.
so
So
not even for the to vote on the project itself. It's just that one freaking platform.
that's what the research says. So you don't actually have shit if you're holding Ondo. Like you've got if you're holding Ondo, it looks like you've got the ability to vote on how the lending market works. But because all of the Ondo supply is held by 10 addresses, your vote doesn't matter. So
Oh, it looked like Aave, where
yeah.
the majority was held by just a couple of wallets, and that was why the DAO left Aave.
And this is a fake DAO. We need to put an F in front of it, just like Aave's DAO. This is an F DAO, a fake DAO, because if there's in the case of
I just confirmed. I went to their website and it says if you hold native Ondo token, you have governance rights over the Ondo DAO and the auxiliary lending platform Flux Finance.
right, well, it looks like the Ondo DAO. If 10 wallets hold 65% of the supply, that is not decentralization.
No,
Okay. And so this is a fake DAO. We need to come up with a different word to describe fake DAOs like this because we see them all the time. Um,
centralized DAOs.
yeah, no, it's a foul. It's or a cow, a CAO.
It's a cow, a centralized,
Yeah,
freaking yeah,
centralized autonomous organization. It's
yeah.
not a DAO. It's a
No.
cow. Yeah. So Ondo token holders possess absolutely no legal, structural, or cryptographic claim to the protocol's cash flows. It's strictly a political instrument deliberately decoupled from economic value capture. Dude,
So important.
dude, dude.
So important.
So then let's bring it on back to the chart of this thing, right? So if now that we know what this token actually is,
That pump is pure speculation and or manipulation based
just
off of
sell this, sell
I,
the pump,
I've
fade it.
been I've been posting for like all weekend. I was posting take profits on Ondo, take profits on Ondo, take profits on Ondo into that pump.
You have to because this token is bullshit. Like it says here, it is strictly a political instrument deliberately decoupled from economic value capture. and there's a lot of economic value that's generated
Oh,
by
a
the
shit ton.
protocol.
No,
So
no, Ondo is going to be, it's been adopted and being adopted, and a massive amount of TVL and value is being put on that on that chain. So yeah, absolutely,
So, I mean, but why in the world would anyone ever hold this thing? I
because
think,
they don't know any better.
right, because they don't know. Right.
They
That's
they
the
just
only
they,
reason.
they don't understand how tokenomics play into what they're buying. They just see and it happened to me. I'm not calling anybody stupid. It happened to me when I first got into crypto. I bought into Shiba Inu, just because I saw a bunch of posts on social media. I FOMO'd into it. It pumped. I made some money, but I didn't understand that it was a meme coin and that there was absolutely nothing behind it. I've bought into Ondo and a lot of these projects even after I've been in crypto for a while. Before I learned from David, the importance of understanding the tokenomics, and if there is even a connection in between the token and the profitability, of the protocol's cash flows. And that's why I got rid of a lot of my projects like XRP, like Ondo, and others.
Yeah, so let's finish out this slide deck just to see because now we can play that video content.
All right.
So it looks like yeah, SEC exemptions. So there's still regulatory risk with this, but because these guys are backed by BlackRock, they're going to be fine. Um, Shadow banking vulnerability, off-chain counterparty dependency. So it looks like demand deposits at First Citizens, so it's got a triple B plus rating, and Morgan Stanley A plus rating. So FDIC receivership traps fiat reserves. Okay, this is if things were to blow up and Ondo were to have a big problem. All right, smart contracts and Oracle centralization. So, oh yeah, this is if there's an insider at Ondo somewhere, and they've got God mode, they
Yeah.
can totally fuck everything up if they wanted to. So just keep that in mind. A
So
compromise.
basically, what it's saying is the administrative keys hold unilateral power to globally revoke KYC status. So basically, if somebody has those administrative keys, they can lock out everybody that's KYC'd.
Yeah, I mean, a compromised key could theoretically freeze all user assets and halt the entire Flux lending engine indefinitely.
Well, basically, kind of what we saw happen on Aave and a lot of other platforms where they locked those pools and things like that to keep people that flight of liquidity.
So ask yourself, is that decentralized
Not
organization?
any way whatsoever.
Nope. Okay, here's the conclusion. The reality of this is not Wall Street 2.0, but this is what the slide deck says. So it says the blueprint is achieved, but there are major trade-offs. The Ondo token lacks intrinsic cash flow value. So let's just repeat that. The Ondo token lacks intrinsic value. Okay, it's heavily inflationary because of these multi-year unlocks, and it's got a there's a bunch of regulatory risk. So, Ondo Finance is not a trustless protocol. It's a highly optimized, digitally native iteration of traditional shadow banking. So it's establishing this dominant standard for a big RWA push. But there are problems with this architecture. This might just be, the first beta version of Wall Street 2.0. I think that there's going to be, there should be much, much greater innovation. Ondo sucks, but let's go ahead and play this and let's see this video content. Mike, let me know if you can't hear it.
All right.
When global markets transitioned to a sustained high-yield environment in the early 2020s, the opportunity cost for crypto investors became severe. Holding standard stablecoins that yielded zero. To see exactly how these technical and legal frictions are resolved, we are going to reverse engineer Ondo Finance, a protocol currently managing over $3 billion in assets, from first principles. We will examine the highly compartmentalized corporate legal structures they use to shield the collateral, the custom forked smart contracts required to geographically gate liquidity, and the actual tokenomic reality of their native governance asset. Integrating traditional sovereign debt into a permissionless network requires navigating an exceptionally hostile regulatory environment. Doing so successfully is the mandatory prerequisite to unlocking the next massive expansion in decentralized finance.
Oh, look, it's the commissars of securities.
Right?
Yeah. Oh, thank you, comrade.
The most pressing operational challenge is remaining compliant with stringent U.S. securities laws, while simultaneously writing and deploying open source code. Ondo handles this through a highly deliberate split-brain organizational design. On one side is Ondo Finance, Inc. This is a U.S.-domiciled Delaware corporation that operates strictly as the software development team and an SEC-registered investment advisor. On the other side is the Ondo Foundation. This is an independently governed, nonprofit entity legally domiciled in the Cayman Islands. Its sole mandate is the political stewardship of the ecosystem and the management of the decentralized tokens. To issue tokenized assets, the system utilizes bankruptcy remote special purpose vehicles, constructing a firewall between developers and debt issuers. Treasuries are ring-fenced inside entities like Ondo USDY LLC. If the software company faces insolvency, its creditors have zero claim to the SPV's sovereign assets. This meticulously compartmentalized architecture satisfies U.S. regulators by placing the software advisory team within their perimeter, while mathematically protecting the end user's collateral offshore. With the legal infrastructure secured, the protocol deploys its core real-world asset products, primarily USDY and OUSG. USDY is structured as a tokenized senior secured bearer note. It is issued under SEC Regulation S, which permits continuous offshore offerings, but strictly prohibits any ownership or participation by U.S. persons. This chart shows the risk management mechanism for USDY. The issuer maintains a 3% junior equity buffer. If underlying treasury bonds drop in value by 2%, this equity buffer absorbs the entire loss. The token holders remain completely unaffected and fully over-collateralized. For onshore capital, Ondo offers OUSG. This product relies on the SEC Regulation D exemption, restricting access solely to highly capitalized institutional qualified purchasers inside the United States. Initially, OUSG relied on traditional BlackRock ETFs as its underlying asset base. This created a massive friction point. Traditional ETFs are bound by legacy T+1 settlement cycles within centralized brokerage clearing systems, heavily restricting liquidity. To solve this latency, Ondo executed a structural pivot. They migrated a substantial portion of OUSG's backing directly into BlackRock's natively tokenized BUIDL fund. This migration enabled the deployment of the Ondo Nexus, a proprietary liquidity routing technology designed to seamlessly execute atomic conversions between OUSG and deep liquidity stablecoins like USDC. By interacting natively with the BUIDL fund, the Nexus bypasses legacy bond market delays, enabling instantaneous 24/7 redemptions. Accessing this institutional wrapper typically carries a 0.15% management fee, alongside a 0.15% fund operational fee. Linking a tokenized wrapper directly to a natively on-chain institutional fund turns sovereign debt from a static, slow-moving traditional asset into a high-velocity digital instrument. The tokenization of sovereign debt solves yield, but highly restricted assets like OUSG have zero utility in standard decentralized lending markets like Aave. Those protocols cannot legally enforce KYC compliance on the unknown actors executing liquidations. To make these highly permissioned assets truly capital efficient, the entire ecosystem required a bespoke credit facility, Flux Finance.
Bespoke.
Architecturally, Flux operates as a peer-to-pool over-collateralized lending protocol, built as a sophisticated fork of the battle-tested Compound V2 codebase. To support regulated collateral, developers introduced deep modifications, deploying customized logic inside the C-token cash contract. This contract intercepts standard functions, cross-referencing the executing Ethereum address against an on-chain KYC registry. If not verified as a compliant purchaser, the transaction mathematically reverts at the base layer. This creates a unique dual-sided market. Retail users globally supply permissionless stablecoins to earn algorithmic yield, while KYC-compliant institutions supply sovereign debt to extract liquid working capital without selling their bonds. Flex Finance successfully forces strict geographic regulatory compliance onto a completely trustless, algorithmic credit facility, patching KYC rules into smart contracts on general purpose blockchains like Ethereum creates immense friction, elevated gas costs, and centralized points of failure. To structurally resolve these limitations, the protocol initiated the development of the Ondo chain, an application-specific Layer 1 built upon the Cosmos SDK architecture. This architecture embeds compliance enforcement, identity verification, and automated corporate actions directly into the base layer state machine, completely removing the reliance on fragile smart contract wrappers. The consensus layer is strictly dated. Only regulated traditional financial entities, like commercial banks, can operate validator nodes, while the transaction layer remains public. Instead of locking speculative native tokens, validators secure the network using tokenized US treasuries that already sit on their balance sheets. The base layer also natively integrates enshrined oracles, allowing the chain to achieve consensus on real-world asset values and proof of reserves directly within the protocol itself. By deploying an application-specific chain, the tokenization of real-world assets stops being a bolted-on afterthought and becomes the foundational economic security layer of the blockchain. Despite these deep infrastructural achievements, evaluating the multi-billion-dollar valuation of the protocol requires examining its native governance asset, the Ondo token. There is a deliberate tokenomic contradiction at the core of the system. The Ondo token is structurally decoupled from the massive cash flows generated by the protocol's underlying real-world assets. The management fees and lucrative yield spread from USDY do not flow into the DAO treasury. This capital routes exclusively into centralized corporate entities.
The most important part.
Yeah.
So yeah, this is by far the most important part for anyone, thinking about buying Ondo or holding
Yeah.
Ondo. Like this token has nothing to do with the cash flows.
It has everything to do with funding, funding Ondo's growth and operations.
And the entity that owns and controls Ondo is completely separate from the entity that builds out the software.
Yeah.
This. So, yeah, if you hold Ondo, I would rethink what you're holding.
Yeah.
Possess absolutely no claim to this revenue, functioning strictly as a political instrument for lending market parameters. This lack of economic capture is paired with severe supply-side pressures. Billions of tokens allocated to venture investors and ecosystem growth are locked in rigid vesting contracts, generating continuous, daily inflationary unlocks extending into early 2029.
Wow.
Purchasing the Ondo asset grants investors administrative power over a decentralized lending market, but provides zero economic exposure to the protocol's highly lucrative treasury products.
Wow.
Looking past the cryptographic logic reveals the intricate web of centralized, off-chain dependencies propping up this $3 billion system. The physical fiat reserves backing these digital tokens are not held in a decentralized smart contract. They sit in standard demand deposit accounts at traditional commercial institutions like Morgan Stanley. The entire product suite exhibits extreme concentration risk, relying heavily on BlackRock's underlying infrastructure and their continued willingness to partner with crypto-native firms. And in the event of a catastrophic protocol failure, an immutable smart contract cannot seize physical assets. Only the Ankura Trust Company possesses the legal authority to step in, liquidate the treasury bonds, and reimburse token holders. During a true market panic, the instantaneous speed of an on-chain bank run would severely outpace the bureaucratic, real-world litigation required to execute a traditional trust company liquidation. Ondo Finance has engineered a highly effective, institutionally credible bridge between Wall Street and Web3, but sophisticated market participants must recognize the trade-off. You are exchanging trustless cryptographic guarantees for a highly optimized, digitally native iteration of traditional shadow banking.
Yeah, no, this sounds like dog shit wrapped in dog crap.
Yeah.
Yeah, I wouldn't touch this thing at all.
Yeah.
Okay, so now that we've learned a little bit about Ondo, let's take a look at Ton. So I'm curious because I actually do like Ton. I like it quite a bit. I like the fact that it's baked into Telegram. It's easy to send value to other users on Telegram, and there are some actually some interesting products that you can use. Unlike Ondo, which is this private permissioned, well, not necessarily private, but permissioned walled garden. TON is open and permissionless. So we've got 8 minutes here for this piece of video content. Then I've got the slide deck for TON. So let's take a look and let's learn a little bit here about TON.
Ethereum standardized the decentralized finance landscape through synchronous, single-block execution models. The Open Network, or TON, deliberately abandons that architecture. This structural departure is a strict engineering requirement to process the digital traffic of Telegram's massive, active, 1 billion-strong user base. To handle that volume, TON operates on an asynchronous message-passing framework known as the actor model. Instead of resolving complex sequences simultaneously, the network's computational tasks are fractured into independent data packets that execute concurrently. Evaluating this network requires deconstructing its underlying consensus layers and navigating its isolated smart contract environment, examining the user abstraction tools driving adoption, and mapping the severe geopolitical vulnerabilities threatening its liquidity. Processing consumer-scaled traffic natively means tearing down the core mechanical assumptions of decentralized finance and rebuilding them from the ground up. This diagram illustrates TON's heterogeneous multi-chain structure, designed specifically to prevent the computational bottlenecks that plague older networks. At the top is the master chain. This is the central nervous system. It strictly stores global state hashes and manages validator elections, deliberately isolating the overarching consensus from the heavy execution overhead of individual applications. Connected directly below are the work chains. These function as independent, customizable blockchains. Developers can define specialized rule sets and virtual machines for privacy proofs or high-frequency trading, as long as they maintain basic interoperability with the master chain. The execution capacity expands at the bottom layer through dynamic sharding. When the network detects a surge in real-time traffic, it automatically splits the load across new shard chains, merging them back together once the volume subsides. If a highly anticipated GameFi token launches and triggers millions of immediate interactions, the resulting congestion is contained entirely within localized shards. By separating intense smart contract execution from the foundational ledger, heavy localized traffic cannot drag down the performance of the wider ecosystem. This isolated execution strategy extends directly into the programming environment itself, the TON virtual machine, or TVM. This side-by-side comparison highlights the difference. On the left, Ethereum's virtual machine processes a complex, multi-step sequence atomically, entirely within a single block. On the right, TON treats every wallet and application as an isolated contract. They communicate by passing messages, meaning a single interaction triggers a sequence of state transitions spread across multiple separate blocks over time. This non-atomic reality breaks traditional decentralized finance mechanics. A risk-free flash loan is impossible to execute securely on TON because the system cannot guarantee the borrow and repay functions will conclude sequentially within the same unalterable block. Contracts must also pay continuous rent for their on-chain state storage. If an application's native token balance depletes, it is frozen and eventually deleted, permanently preventing state bloat.
Wow.
Historically, developers had to navigate this asynchronous complexity using a rigid, low-level language called Funcsy. By 2026, the ecosystem abandoned it, pivoting entirely to a modern language called Tolk. Tolk introduces a strict type system and handles corrupted inputs predictably. Instead of forcing developers to decipher ambiguous legacy exit codes, Tolk returns standardized failure opcodes. By abstracting the severe friction of message-based engineering, Tolk lowers the barrier to entry for enterprise developers while retaining the ultra-low gas optimizations required to sustain massive throughput. Throughput capacity expanded drastically in April 2026 with the deployment of the CatChain 2.0 consensus upgrade. By optimizing the Byzantine fault-tolerant logic, the network compressed block generation intervals from 2.5 seconds down to an aggressive 400 milliseconds, achieving sub-second finality. As this equation shows, accelerating the machinery created an immediate monetary crisis. With the static protocol block reward remaining unchanged, producing blocks 6 times faster caused the annualized token inflation rate to violently spike from 0.6% to 3.6%. This occurred simultaneously with a strategic, network-wide decision to slash baseline transaction fees by a factor of 6, dropping the cost of a smart contract interaction to a fraction of a cent to support Telegram's microtransaction economy.
Yeah, but on the dApps on Ton, that has not been my experience. Gas, at least my experience has been that gas is not this cheap on Ton.
Ton traditionally combats inflation by burning 50% of all user transaction fees. However, by drastically lowering the absolute cost of those fees, the network neutralized its own deflationary counterbalance. To stop the systemic devaluation of the asset, validators were forced to schedule an emergency governance vote, severely slashing the base master chain and work chain block emission parameters to bring the inflation rate back below 1%. Upgrading a decentralized ledger to operate at the speed of modern web servers introduces immediate macroeconomic volatility, requiring real-time manual intervention to preserve the token's purchasing power. The purpose of this technical scaling is to capture and monetize Telegram's vast communication network. We can map this conversion pipeline in 3 tiers. Users discover gamified mini-apps through social referrals at the top. To claim rewards, they initialize a native wallet in the middle. Finally, they swap these assets or generate yield natively on-chain at the bottom. In a traditional Web3 ecosystem, this pipeline breaks at the middle tier. Forcing a user to acquire a highly volatile network gas token simply to pay the initial validators destroys retail conversion. Ton bypassed this hurdle entirely by rolling out the W5 Smart Wallet standard in tandem with native authorized Tether. With the W5 architecture, a user holding exactly 0 Ton can seamlessly transfer stablecoins. The smart contract automatically splinters off a minuscule fraction of the Tether payload, routes it through a decentralized exchange to acquire Ton in the background, and compensates the validator. By hard-coding the complex mathematics of gas payments directly into the abstraction layer, the network effectively turns a messaging app into a borderless peer-to-peer settlement rail. This highly efficient onboarding funnel exposes the severe centralization paradox at the core of the ecosystem. In May 2026, Telegram formally executed Step 3 of the Make Ton Great Again roadmap, transitioning the corporate entity into the position of the network's largest institutional validator. Locking massive corporate treasury assets into node hardware strictly aligns Telegram's financial survival with the security of the blockchain. It also concentrates immense protocol governance and block production authority into a singular, centralized private company. This corporate dominance sits atop a highly concentrated historical token distribution. The network's early proof-of-work era left the overwhelming majority of the Genesis supply clustered within a small subset of insider and foundation-adjacent addresses. To contain this overhang, massive portions of the supply were sequestered in the Believers Fund smart contracts. As this visualization demonstrates, the active circulating float is dwarfed by this deferred inflation. The programmed release of 37 million Ton per month introduces persistent structural sell pressure into the secondary markets. These internal tokenomics are entirely subordinate to the ecosystem's overarching geopolitical risk, state pressure on Telegram's executive leadership. Following the 2024 indictment of CEO Pavel Durov by French authorities, Telegram reversed its historical privacy policies, formally complying with European Digital Services Act mandates and agreeing to share user IP data in response to legal warrants. A decentralized protocol relies on censorship resistance to maintain trust. If state actors can legally compel the messaging layer to geofence crypto functionalities or surveil users, the primary pipeline feeding liquidity to the network can be severed by regulatory decree.
Wow.
Ton has engineered the architecture required to process decentralized finance at consumer scale. The outstanding question is whether a truly permissionless financial ledger can survive while permanently tethered to the compliance realities of a centralized corporate entity.
Nope. Yep. So I didn't realize that after Pavel Durov got arrested because he decided that it was a good idea to fly to France, where they ambushed him and locked him up for like a week, and basically like forced him to give them the keys. The French did that. He's French citizenship, or at least he did. So yeah, it seems like they successfully got their claws into Telegram. And I thought that Telegram was private. Turns out it's not.
It's, I mean, it's why it's so important that we learn about the tokenomics of these projects. Is if and again, if you want to invest in these projects or trade them short term, based off of news and volatilities, up to you. We are just here to inform you. What you do with that information is up to you.
Yeah, and taking a look at the slide deck here, let's just run through this. So the super app thesis, merging decentralized rails with Web2 scale. So, there are some interesting protocols on Tom. Um, I like the Storm Dex. It's a perps Dex. Eva protocol seems to be pretty good. Um, I think that there's another protocol on there too, like a liquid staking protocol. Don't recall the name of it right now. And then you've got StonFi and DDust. Those are decentralized exchanges too. So this asynchronous machine that Ton has built, the problem for me is that it seems as though Ton can be compromised by governments. So it looks like governments could compel Ton to potentially freeze wallets, freeze transactions, provide wallet data, provide IP addresses, provide user data, and like that's a real problem. That's a real problem. And when they talk about all of these upgrades, latency and finality of 400 milliseconds and fee compression, below like a fraction of a penny, this has simply not been my experience when operating natively on Ton. So, I don't know where the research is getting this from, but I think there's a big difference between like theoretical latency and theoretical gas fees and what it actually is in real life. So, here we go. Web 2 messaging to on chain yield. Great. So, the one thing that I really like about Ton is that it's got all these users. So, I was thinking that because of all the users, that could mean much more adoption for the Ton chain, but it seems as though that doesn't necessarily translate into number go up for the Ton token. Now there is quite a bit of USDT in circulation, but again, USDT can be frozen, and governments, especially in Europe, these European governments, they totally would freeze or freeze assets if they don't like someone's speech. That's what they do.
Oh hell, the UK is throwing tens of thousands of people in freaking jail
Oh
for
yeah.
for tweets.
Oh yeah, and what the UK is doing right now and has been doing for the last several years, the USSR would be they would be embarrassed
Yeah,
because like the UK is outdoing them like by
yeah.
an order of magnitude,
Oh yeah,
um,
they're
and
number one with a bullet.
and not to mention the decades of Pakistani Muslim rape gangs there. So like that's just horrible in the UK. Okay, so back to Tom though, the decentralized exchanges there, StonFi and DDust. So StonFi and DDust, these as dexes go, they suck. Like they're not
Yeah.
very good. UI UX is just kind of meh. They don't really have much by way of features. So, but you have no choice but to use them because that's all that exists. Ton Stakers is the liquid staking protocol. Um, and then EVA protocol is the money market, the lend borrow protocol. This one is very simple. It's a very simple money market. You can only supply like a handful of assets and only borrow a handful of assets. So really not a whole lot you can do in DeFi on Ton unless you want to be able to trade on Storm. Storm is the perp stacks on Ton. So you definitely could, run some recursive loops over on EVA protocol. But let's take a look at this tokenomics. So this is really what we were trying to get into. Telegram officially halts involvement, pays fines. So again, regulatory risk. That's That's what I'm going to take away from this research here today, Mike, on TON, is that there seems to be significant regulatory risk with that protocol. So I would just be careful holding it. And now that I've done a little bit of deep dive research on it, it's getting crossed off my buy list.
Yeah.
Tom's no longer on my buy list. Yeah.
Yeah.
Cool, man. I think we've hit time.
Awesome. No, that's freaking great information. I actually learned quite a bit on both those projects. So yeah, no, I definitely appreciate you putting that information together. And I hope everybody out there, again, what you do with the information is up to you. Please don't just simply disregard it because you think it's FUD or something like that. Please, please, please remove your emotions. By all means, feel free to do your own research. If you want to post on social media after doing the research and you want to link to your sources and you want to tell us we're full of shit because we were wrong about something, absolutely. We are all about everyone out there. If we get something wrong, please, by all means, let us know, because we want to make sure we're putting good info out. But, this verifies what it is that, when I did my research on Ondo, this verifies the research that I did. So, I have yet to find anything that contradicts, what we put out. So, David, thank you. And if everyone out there, if you want to, let's see what we got going on the rest of the day. So Tuesday, we got the market wrap. So today is a live coaching day. So you're going to get about 15 to 20 minutes of technical analysis at 4 p.m. Eastern, 1 p.m. Pacific. And the second half of the show, or second 3/4 of the show, is going to be Ellie and David going over the live coaching. So David will be teaching Ellie how to use DeFi and how to enter certain positions. Do you know what you're talking about today?
Yeah, I think what we're going to do today is take a look at the SUI chain. So, we started off on, of course, Ethereum virtual machine chains. And then, I believe it was last week, we were taking a look at Solana a little bit. 2 weeks ago, we were operating on TON. And today and this week, we're going to take a look at SUI.
All right. Sounds great.
I'm not sure exactly what we're going to do. Well, what I want to do is I want to walk Ellie through what it is that I look for when I'm exploring a new chain.
All right.
So I've operated on SUI plenty in the past, but I see in the comments that Not Scoot Boy is saying that he's not exactly looking forward to using different chains aside from the ones that he's already using. I think that it's really, really important to become comfortable, exploring a new chain. So that's what we're going to do today. We're going to explore SUI, and we're going to see if we can find some interesting, either interest rate arbitrage opportunities or stat arb opportunities. We're going to see what's going on SUI.
Sounds great. So if you want to join David and Ellie for that, again, 1 p.m. Pacific, 4 p.m. Eastern, and tonight, 8 p.m. Eastern, 5 p.m. Pacific, myself and Jeff will be doing Crypto and Chill. So be sure to join us. And until next time, Veteran Crypto out.
Peace.